Hello and welcome to the Inquisitive Investor Podcast. I'm your host, Parijat Garg, and in this show, we explore how the smartest investors and entrepreneurs think about business, markets, strategy, and process that help them succeed at what they do. My guest today is Pranav Kumar. Pranav is a private equity investor who has pursued his curiosity about how the world works through a journey that has taken him from management consulting in India, development economics in Asia and Africa, and now private equity and financial services in Asia. I've known Pranav for almost 2 decades now. He's an extremely structured thinker and has a fantastic ability to break down complex ideas into their component parts. I hope you enjoy my conversation with Pranav Kumar. So, welcome, Pranav. It's great to have you today. It's been a long time since we've been planning this. Good to finally be able to sit down and record.
Thanks for having me, Parjat.
So, Pranav, before we even get into details of, I have a bunch of questions lined up that I want to ask you. But just for the benefit of our audience, it would be great if you could tell us a little about what you do.
I work in private equity. I mainly invest in financial services and fintech companies in Asia. Asia is mainly India, South Asia, and Southeast Asia for me.
Your initial education did not set you up for private equity, right? You started your journey with a degree in computer science, which is where we first met, of course. So walk us through the journey, from graduating as a computer science engineer to ending up in private equity.
That's a good question, and I think for many people, where they end up, they can't claim to have all planned it from the beginning, isn't it? So I was fortunate to study computer science at IIT Bombay with you, Parijat, and others. And as you know very well, some of it was a lot of fun. I was, however, really keen to understand how the world works. And after my IIT, I was just keen to figure out what is the best way to achieve that. And an opportunity presented itself with an offer from IIM Ahmedabad, and I jumped at it. And it did expose me to a number of areas. And after my MBA, to be honest, I continued to feel that I did not fully understand how the world worked, more specifically business world worked. And therefore, I thought management consulting, specifically McKinsey, where I got an offer, was a great place to learn. And it was a good place to learn, to be very honest. What happens with younger folks in a place like McKinsey, that they get exposed to a number of functions, a number of industries in big companies working on important problems. And we can debate how effective our solutions are. But I really believe that people get very serious exposure to many different kind of business problems in a number of settings. So that was really helpful. And an additional thing which completely surprised me, I hadn't expected that I'm going to learn this, but I did. And I hadn't expected that I would be very interested in this, which I was the whole thing around influencing people and managing work through high quality communication. Now, this is the softer side of what they do teach you at MBA. But when you see this in practice, you can realize the importance of it, importance of communication and importance of influencing in getting things done, organizing teams, and therefore organizing society as a whole, right? So that was very interesting. I also developed a keen interest in development, economic development, and decided to move to World Bank and worked in a few countries doing that. But finally, I think I do feel home doing investing, especially private equity investing in emerging markets, where you have to combine how business works, how growth happens, and how to deal with people. So that's what I do now.
That sounds interesting. A combination. It's almost lucky to be in a place where 2 or 3 different life goals seem to sort of merge. As you mentioned, getting a better understanding of how the world works, being able to manage people, development. Yeah, so that's actually, it's almost lucky. So now that you've got the you've spent time as a consultant and now as investor, and as I understand, most of it was in the financial services industry. So in terms of your goal of understanding how the world works, I imagine that you have a much deeper understanding, at least, of how the financial services industry and the financial world in general works, right? So what are some of the interesting insights that you've got and you've learned about how the system works, and what's important, what matters? Any interesting stuff that you've learned that you can share?
So I'll take a couple of examples from the industry I focus on. And before the example itself, I think the approach to think of a dynamic system where different levers and variables interact with each other as a mental model is quite helpful. So in lending, for example, I personally pay a lot of attention to opex, operational efficiency. Now with growth, everybody's opex ratios improves, and everybody will present your business plan where they will grow their asset under management, and their operational efficiencies will improve as a result of that. But those who can crack it, even at a low scale, have the extra bits in the ROA tree, to use a jargon, which creates strategic flexibility and a virtuous cycle. What I mean by that is, if you have these extra bips, you can, of course, realize them as profit, or you can choose to lower your yield, which could lower your credit risk, which could lower your financing cost, and which lends you to a virtuous cycle in which you're also well placed to grow. And similarly, the opposite of it, if you build in too much OPEX too quickly, which is sometimes easy to do, especially if you want to invest a lot in technology upfront. If you build in too much of that upfront, then you have to do the opposite of this virtuous cycle. So you have to play at a higher yield. You have to take additional risks because of that. And if you take additional risk, your liability unlocking that will be harder. And therefore, and your target market also is smaller if you want to maintain that risk level. And therefore, it is very hard for you to get out of that cycle. So that's an example of where the trade-offs are very interlinked, and a business and a leadership team has to figure out how to break out of that to create a distinctive business, because there's kind of no free lunch left to take. So that's an example. I guess a related point, the second example, is that size itself kind of becomes a big moat in some of these balance sheet businesses. So a big insurer, for example, which is another risk business, they will have a cost structure just because of their size, where they are basically competitive on any product in any segment. Because product differentiation is a bit hard in financial services. It's easy to copy. And therefore, I guess the other insight is very, very crucial, is to think very, very carefully about quality of growth. So if you are a small general insurance company growing at a very high growth rate, there's a real question to ask that, why are you getting this growth on the basis of a much poor cost structure compared to the industry leaders? And you must seek very good answer from the business and their leadership team to this question, because the chance of adverse selection is very high. It is quite possible that where you're playing is just unattractive for the big players to play in, and therefore you are making a risky bet by growing in a risky area. And the other thing, which is, I guess, common to lending and insurance, is that growth and quality of growth cannot be measured concurrently, right? So you can observe growth, but the quality of that growth you can only observe with a lag, when the risk will have some time to play out. So those are two examples of, I guess, you need to be very mindful of investing in these two segments.
Maybe I'll just jump ahead a little and maybe unpack what you just said a little before we go back to more general questions. So you said that managements that can get lower opex, operational expenses in their business, have a natural advantage because of that additional buffer. So the first question, of course, is what are the differences you've observed between low opex and high opex companies? Where are the principal savings that people end up making in operational expenses? That's one. And maybe, sort of unpack a little more this whole thing about lower operating costs leading to hopefully lower credit rates that you charge, and the knock-on effects on the quality of credit you're extending, etc.
That's a good question. I think, again, it sounds a very soft topic, but a big part of this is just in terms of mindset and DNA of the leadership team, founders and leadership team, that really kind of sets the tone for the rest of it. So one very simple but obvious place to look at is just the location, right, of the head office. So which city is the company located in? And even if it is a big and expensive, I guess in India, Mumbai is the most expensive rental market. Even in a city like that, where exactly do they actually place their office? And of course, you have to be discerning, right? Sometimes the lending business is one of the many businesses of a conglomerate, and it's a different situation. But if you're a standalone entrepreneur, in my case, mainly dealing with what would be considered small caps in the listed market. So if you're a small cap, that's an important decision, right? And then it's a lot of trade-offs. So for example, a lot of people who face this trade-off come from the technology background, where it is very normal and very obvious to make a lot of investments upfront in team and setting up the technology. And then you also have to trade off, and you, Parijat, know a lot about this than me, is you have to also trade off about how sophisticated and how far you want to push your product and how quickly before you actually have traction, right? And there are a lot of those trade-offs to be made. So I guess it's all about, therefore, the DNA and mindset and the decision-making process, where you put certain weight on certain variables. So you do not want to not invest in technology, but you also do not want your opex to become hairy, which will lead to strategic decisions on customer segment, which is not the way to play the game, right? It should always be the other way around. You figure out your customer segment, what you're trying to solve, and then figure out supply for it. And opex is a subset of supply. So that's where I was going from. If you lead from development, you are in danger of figuring out a customer segment that fits your supply and cost structure rather than the other way around.
Explain that a little more. So what I hear you saying is that if cost structures are high, you will have to offer loans that are at a higher interest rate, and that will force you to get customers that have lower credit quality. Is that right? And is there more nuance to that?
Yeah. And the only nuance I'll add, you're absolutely right. Nuance I'll add is on the liabilities, because liabilities interact with your yield and credit cost. So if I'm a credit rating agency, I much prefer someone doing a safer customer segment with a lower yield, lower credit cost. And therefore, if I'm a banker who is trying to give liabilities to you, I'll also think similarly, and I'll go by what the rating agency says. So that part of the equation will become a major bottleneck to growth later on, when you are suddenly become big on a high yield loan and high cost structure. You struggle to unlock a lot of liabilities.
So what I hear you saying is that if you're a smaller player, you want to keep your OPEX low and then go after the higher quality borrowers early in the game. That's one thing I hear you saying, and you can correct me if I'm wrong on that. The other sort of related question from here is you mentioned that size is a moat. I'm assuming both in insurance and in lending. So, what's the trade-off here in terms of, maybe making early investments where maybe you lose money and, ramping up quickly to a size where that opex levels off and you get back into the same operating profits margin, but you go after that growth to build that moat that size brings. Is that a reasonable trade-off? And how does that trade-off play off?
Yeah, so that is a trade-off, and there are companies that have done it successfully, and there are companies that struggle to do it. One reason for this, at least in balance sheet businesses, which is both lending and insurance, and even a number of fintechs, at least on the lending side, over time have had to go to balance sheet. I believe majority of them have a balance sheet or are planning to have a balance sheet. So for this whole group, I think you're right. You can trade off, go for size, and then everything works out. I guess my view is, and my suggestion is to just appreciate the risk here of this path. The risk in this path is that you are very dependent on external fundraising, especially equity. I think also debt. But if debt doesn't come, you're again back to equity. So you're very dependent on equity fundraisers in a very substantial manner, because your balance sheet and your growth basically requires more capital, right? And if you're a high cost structure, most likely you may be losing money, or you may be low ROEs. Therefore, retained earnings cannot support high growth. So it's dependent on that, and that is fine. A lot of companies have taken money, raised capital, and proven to be successful. But it is a risky path because, as we all know, I mean, capital markets are very cyclical, and equity is not always plentiful, and it's difficult. So it's a risky path, and especially in the chances of down rounds and things like that, it's a risky path, is what I would say.
Okay, so let's talk about what is the nature of the moat that you get from the size. So one is, of course, that the fixed costs that you have compared to your book are lower, right? That's one. What are some of the other advantages of size? And of course, they could differ in insurance versus lending. But can you talk a little about what those advantages are that large companies have?
Yeah. So, I mean, this one is not a completely novel insight, but especially in balance sheet businesses, I think size is very important. So, cost of funds is the first one, right? Typically, with size, people are able to, it correlates very well to low cost of funds. The other big one is diversification. So there is a trade-off as an investor. And again, I want to be clear that money can be made on all paths, and there are many different ways to generate returns and alpha and so on. But I'm just trying to highlight the trade-offs, right, and risks. So if you're very big, most likely on the asset side, you'll be fairly diversified. You could have exposure to secured and unsecured. Within secured, you could have exposure to, let's say, housing as well as vehicle. Within unsecured, you could have, let's say, exposure to SME and microfinance. All behave very differently, right? So you can have some genuine diversification on the asset side, which leads to some kind of diversification on credit. Hopefully everything is, I mean, they are somewhat correlated, but hopefully they provide you some level of diversification. And then with size also almost demands that you have decent diversification on liability side. So you do not have one lender, you have many lenders, or if you're a bank, you raise deposits, then you have retail deposits and institutional deposits, and current account and saving account, and maybe different geographies. Geography is another axis of diversity. So typically, size would entail that you're quite geographically diversified. So what all of this means is that really that big size is a lower beta play, right? That you're less likely to implode than a peer which is smaller and therefore which is forced to specialize either in a geography or in a customer segment or in some which way that they can earn their keep, right? So it's a lower risk play is the first point. And second point is, I mean, the cost structure does allow you to compete anywhere. I guess that the trade-off with the specialist is that the lack of focus and having a bigger bureaucracy also, typically is an impediment to innovation and being nimble and things like that, right? So I guess the holy grail is someone who is big and yet nimble, like Mr. Bezos. But that's the holy grail, right? But I think if you're an investor looking at a big business, you vary of lack of nimbleness and bureaucracy. If you're an investor in a specialist, then you have to be wary of some kind of tail risks, right? If your particular segment where you're concentrated, which you have to be by definition. Again, it all links to our cost discussion earlier, right? If you are a specialist lender, you cannot develop specialization in multiple industries and geographies. Your cost structure will not allow it. So that's the trade-off, I guess, you look at once you go for size and specialization. And if you have a lower risk appetite, you go for size. A higher risk appetite, you have to be a bit more discerning on which type of lenders you pick on the smaller zone.
Okay, I guess there's a lot more to dig into, in terms of specifically how you look at your investees. But, let's just step back for a minute and, talk about something more general. So private equity, right, as a general practice area, it involves a lot more compared to public equities, especially. It involves a lot more due diligence. There's negotiation involved, much more paperwork, etc. But apart from just this operational work, in what ways would you think private equity is materially different from public markets investing?
That's an interesting question. I think there are some similarities and there are some differences, some big differences. Similarities, end of the day, you're doing equity investing. So equity risks, all the good Warren Buffett stuff, trying to partner with quality people, quality businesses, things like that. Everything holds, right? Margin of safety, everything holds. On the differences, I guess we do a lot more Excel, but I think more tangibly in the analysis stage, right? We do have a lot of access to data. I mean, it is at a different level, right? Because public markets have this big regulator constraint on data that can be shared. But in private markets, you can literally access any and everything. So just to give some example, right? So we get access to a lot of cohort data. So if you're doing lending, for example, you can actually look at how different cohorts of disbursement, let's say every month or every quarter or past, let's say 36 quarters or whatever you want, right? Past X quarters, you can look at how different cohorts have behaved over time in terms of their credit performance. Similarly, if it is a non-credit business or any business, right? You can look at when you're doing your HR analysis, you can really go deep into attrition. Because as soon as you look at your headline attrition and benchmark with a few competitors, the immediate response you will get is, you know what, a lot of this is voluntary and some of this is, 0 to 6 month attrition because these guys come and they figure out it's not a good fit and therefore they leave. But you can test all these claims with data. And then if somebody says that, but we have done these 15 initiatives to improve attrition over time and see this number, but you can then test that hypothesis clearly with data if you wanted to, by looking at different cohorts. You can even look at time of the initiative. You can figure out. And the other very interesting thing is on the people side, right? Because you're not necessarily doing all this analysis in vacuum. Many of them you are relatively closely working and discussing with management, and not necessarily always CEO. You can get access to all CXOs and below if you want. And not only you are going through the numbers from your own first principle basis or whatever you like, but you're also getting the business person kind of framing the issue and analysis in the way the business person drives his or her function, right? Or his or her KPIs. So you can really get a good handle, to the extent it is possible as an outsider. You can still get a decent handle on how the operator is operating. And the good ones will really surprise you and will be very insightful because they would have implemented stuff, right? So the good ones will have insights at second and third level, right? So there's this lot of data, and then there's this lot of exposure to management. And management is not just the CEO, but also the CXO layer. And then you do a lot of interviews of customers and so on. And therefore, I believe that you can triangulate a lot of points in your thesis and come to a relatively deeper understanding of what's going on, I imagine. So that, in my mind, is a substantial difference between these two, between public and private investing. That's also why I was joking that our Excel models are probably bigger, more sheets. But the second big difference I'll just mention is on the portfolio phase. Once we have invested, I think, and private equity is also a very large industry, and there are many firms, and people have different style and philosophy and org structure and so on and so forth. But I'm generalizing a bit here. But generally, private equity will have representatives on the board, and they do have a direct say in influencing the company, the portfolio company. This does differ a lot depending whether the private equity has a controlling stake or a minority stake. It does differ a lot, but you do have a seat at the table, and that makes quite a big difference because you have a lot of visibility into what's going on, as well as you have a say in most of the decisions. So those two would be big difference.
Okay, so access to more information and more insights into the details of the business. Two is control. So both of these things sound like significant advantages over a public equity investor. So does that mean that private equity should, in practice, yield higher returns than public equity investing? I mean, because you've got a substantial edge here, right? So are those returns actually higher over the long run in your experience? And if they are, what is the flip side? What is the corresponding risk that you are taking in addition to public equity investors? Illiquidity risk is, of course, one, which is well understood. But are there other sources of risk here in private equity that make up for the potentially higher return that you get from deeper insights and control?
Oh, that's a great question. I'm sure this question is on the mind of a lot of stakeholders in many parts of the world, and this is a hot topic, I guess, in asset allocation. I think I'll make a few comments. Firstly, that just mathematically, alpha is also a function of entry price in a big way, and it isn't obvious to me that entry prices are not prone to bull market and bear market sentiment, but especially price wars and things like that. I think it is part of private equity as well. So it's not maybe 10 or 15 years ago, I think in a place like India, for example, when private equity was very early days, there would be deals at, let's say, attractive entry prices. But the market is relatively deep now, at least in India, and they are almost always intermediated. By intermediation, I mean generally investment bankers will run the process, and it's an auction process. So pricing tends to be fair. I would like to believe that I probably believe that it is less volatile than public markets. So let's say COVID happens, I don't think that the PE prices depress as badly as public market. And then even on the upside, I think beyond a point, PE prices become crazy, but not as crazy as it can become in public market. So there's less volatility. But we have the pricing pressure. We do have, I would say, a base level of pricing pressure because of auction process. But that said, those two advantages are quite real in terms of data analysis, and therefore experienced firms should be in a good position to avoid mistakes. And control also helps. Again, experienced firms who have some kind of playbook and experience of turning around or putting right people on the company's board or just generally as advisors helps. The other couple of sources of potential alpha, one is a very simple one, but I believe is potent, is that our business model more or less requires PE to hold assets for 5 years or so. Of course, you can sell early and you can sell later, and we can get into that. That's a separate topic. But broadly, we are forced, or we are generally, it is very likely that we'll hold for that long, and that itself is a good thing. If you, as you know, one of the risks in creating returns is not being patient. So our business model kind of requires us to be patient, which is helpful. And the last one, which I guess is probably I could have added to your previous question, but public market investors don't necessarily face it as much, is that there's a lot of structuring. It's not always the case, but it can be involved both at the time of entry and exit, which can support returns. So for example, while entering, suppose you cannot price certain risks. There is a tax liability the company has, which looks substantial, and you don't know what to do with, and it's very difficult to price it. So you can get an indemnity against it. Similarly, let's say the particular company has, in its current form or shape, let's say, is not getting enough investor attraction. So you could do what happens in public market, but you do not control. But in PE, you could control. Part of it is through rights, is that you could potentially spin off the more attractive assets into standalone entities, and they therefore unlock value, because the whole sum of the part arbitrage, which in public market you can observe but not necessarily have agency around it. In PE, you could have, in theory, some agency around it.
That's alpha. What about risk? What are the specific risks that you face in private equity that you wouldn't in public equities?
I'd like to make one quick point on private equities, especially in the West, is predominantly identified with buyouts and leveraged buyouts. Meaning that the buyer is buying control of a company, and they're bringing some equity, but they also bring a lot of debt and use the cash flow from the company to fund some of the debt. That model is not dominant in emerging markets. Emerging markets is much more growth equity, which is also what I do. And then there's also a lot of minority investments, and increasingly, there's also quite a bit of majority investments, but they tend to be more growth. But obviously, in leveraged buyout, leverage itself is a big source of risk. So I'll not go there. That's not necessarily my area of expertise. But in growth, I guess we have the risks that, let's say, a small cap investor has versus a multi cap or a large cap investor in public equity has. Small cap has its own issues. Small firms have additional risk. And the second one, I think you mentioned it, but worth adding a couple of lines is this illiquidity and exit is a big thing. To be honest, this is the other thing we care about a lot in our investment thesis on ability to exit this company. That's a big point. If I have to make 5 points about a company, one of the 5 will be about exit. It's a major point. So we do worry about it a lot. And I think in a deep market like India, IPO has now become a viable path. It's not the case. Even in India, in many sectors, it's not easy to IPO anything and everything. And then it's cyclical. The market is not always open. And then in other countries where capital markets are shallow, it's way more difficult to IPO, or even if you IPO and list something, to have any reasonable liquidity in it. Because if a company is just like a notional listing with no volumes, then the price is basically, it can be anything, right? So exiting then via strategic sale is non-trivial. And especially in financial services, you also get into the regulatory regime, because regulators have very strong laws and regulations around ownership, foreign ownership, local ownership, promoter ownership, and so on and so forth, single shareholder limits. So all of those regulatory issues create friction in exit, which you have to work through, and honestly, it can easily impact price. So those two in my mind are trade-offs, right? And then there is this statistical distribution, as in public market or private market, or I guess any market. There's a distribution of fund managers where people will be all over it. And then even for the same entity over time, it's not very easy to predict who can consistently deliver. And you get into all the investing in fund issue, right? Which itself is a complex topic, I guess. So it's not straightforward,
Sure.
but yeah, but at a guiding principle, I guess experienced manager do have some levers for alpha.
Changing gears a little, I want to zoom out and talk a little about the broad process, and broad process in private equity, or also specifically your own practice, right? So the way I like to think of investing is that there are phases, right? There is idea generation, then you do analysis on an idea, you choose to either put it in your portfolio or not, and then you sort of think about portfolio construction, where it fits, what's the size going to be, etc. And then you monitor it, as it stays in your portfolio, and eventual exit. As you mentioned, exit is in fact an important thing, especially in private equity. So just I want to sort of walk through those steps as they apply to private equity in general, and to your process. So just first, how do you source deals? So one, I'm assuming, is when investment bankers bring you a deal, right? Where the private company is already looking for money, they've engaged the investment banker, and they approach you with a pitch. Are there other ways that you look for ideas? Is this bottom up, top down, etc.? Just talk through that a little.
So again, I mean, there's a bit of caveat. I'm sure different individuals and different firms will have a slightly different approach, but it can be a function of your stage. So you're absolutely right. So for me, we are more growth stage fund. Therefore, in deep markets, as I mentioned, like India, most of the deals will be intermediated through an investment banker. But in shallow markets like Southeast Asia, many are intermediated, but many are not. So that's the first source, which is through bankers. I guess what happens is, even if it is through intermediation, there's still a question of how do you win deals. So it's a marriage, right? So of course you want to decide to do it. But if you decide to do it, and if it's a great company, and I think public market investors also have this experience in the case of IPOs that are very oversubscribed. Even if you decide to invest, it's not obvious to get an allocation. In our cases, generally investment cannot go to too many parties. I mean, one or two usually. I mean, it's not a round that can accommodate many and many investors because we typically need a certain check size, certain rights, board seats, so on and so forth. So the competition in some sense is hard, especially in deeper markets, especially for very good assets. And of course, if underwriting the asset is very difficult and tricky, and it has a business is complex, so performance was not good, and so on and so forth, then maybe it's easier to win. But in that case, the analysis part is tougher and very important. So that's the more incoming. But we do try to do a lot of work on developing themes. It could be as simple as it could be, some combination of screens, I guess, public market investors use it. In our case, it could be anything like, let's say, insurance brokers can be a theme, which are leveraging digital, for example. And then we can try to scan all the players trying to do that in different forms or shape. Not even brokers, let's just say trying to do insurance in a very digital way. And what you then try to do is you go and meet and speak with as many of them as possible, which in private market is viable. It's not, I don't know how exactly, to be honest, it works in public market, but it's quite viable in private market. And that activity does create a lot of, let's say, hypothesis or initial view on where you could potentially play. And then when the time comes, when the company is actually ready to do a fundraise or one of the existing investors ready to sell, you are generally just more prepared to go for it in terms, and that kind of becomes your edge or your competitive tool in kind of winning the deal. So those two things, there's a supply through bankers, but you also try to develop your own themes and just be prepared when the deal actually comes online.
Okay, I understand. So relationship building and you already have relationships and can have an understanding. Okay, so moving on to analysis, right? And just walk me through the big picture here, right? Like the big steps. Let's say an investment banker has just pitched you an idea, right? He's brought a deal to you. Is there like a standard checklist that you would go through? Is there an initial go no go decision that you can take, say maybe in a day, and just like the big chunks of your analysis and decision making process on, and of course, when you finally go through a deal, you would spend a lot of time with management and looking through the data, but at a macro level, like zoomed out, what are the big steps that you have?
It's an important question because I think speed of decision making is a good lead indicator of fund success. So there's something I try to get better at the time. So some of the filters are very simple and mandate related. So there's certain, let's say, themes we do not like or we cannot do. So that's easy. We have a certain check size, that we cannot engage. That's a bit easy. We have minimum governance that we need, like board seats and a few others on exit. If the company is not willing to do that for whatever reasons, that's an easy no. So these are the easy ones. Followed by this is, I think, we are, and I guess many other investors also are, but we're quite keen on working with very reputed partners. So if someone, for whatever reason, has a mixed reputation, so to say, then we would really do reference checks and try to come to a conclusion whether we want to partner or not. And this is just the nature of investing in emerging markets. I think maybe even developed markets, which I don't have much experience in, but it's really important, and I guess most investors appreciate it. I guess founders also appreciate it. So that's an important filter. And then quality businesses, right? So to be honest, what happens is that in my experience, there are two types of business. you have a lot of depth. The reason you have a lot of depth is because you have invested before. You already have portfolio company in similar or adjacent area, and therefore, personally or as an institution, you have a lot of deep knowledge, and that does allow for quicker analysis, so to say, right, and a quicker no if you have that. But in some cases, you don't, and you are trying to figure it out. And if we are trying to figure it out, then I guess there are two situations. One where numbers are all just great. So it prima facie looks great. So you just want to move forward. But in some cases, numbers are mixed, right? Or it's not obvious. That requires a deeper diligence and analysis. So I guess we take calls on whether or not we want to get into that or move on. So that one requires a bit more judgment, Parijat.
All right. So now, once you've sort of figured out that you're doing the deal, how do you think about portfolio construction? And now, in public markets, there's obviously fairly well understood. You probably have some kind of sector underweighting, overweighting mandate, and things like that. And you can do, maybe if you are very quant oriented, you can do a portfolio risk kind of thing using covariance matrices, etc. But I'm assuming that doesn't work here. So, how do you think about portfolio construction in a private equity context?
So the intuition is very similar, I guess. So we would be careful with geography, not to try to do too much in same geography, right? Because as an international fund, we have kind of access to many markets. We would similarly be careful to invest across sectors and within financial services, both credit and non-credit, just to diversify the risk. The other one, which has become a bit interesting in recent times, is the axis around tech and traditional. Now, even every traditional company is also doing a lot of tech, but then there are some, new age digital tech companies, and it is impossible we are agnostic. We're not a venture fund which is doing only tech. We do a lot of traditional companies, but we also do a lot of tech companies. So there's that axis in which we try not to do way too much venture and tech because it has a slightly different risk profile. So if you do not have, so you can be, in venture there's a bit of this power law. So you better do a lot of bets in order to make sure that some of them are power law return. So we are careful about how to think about that axis. And the other axis, interestingly, I think is around operational capacity and operational resource intensity that the portfolio company might take. So, for example, it would not be a good idea to have a fund with, let's say, 10 investments and all 10 are turnaround, to make an extreme example, and therefore everything requiring a huge amount of operational effort post-investment, right? So you'd like to balance that. So I guess those are some, but it's all very dynamic, right? You also have to consider what deal flow you have. So it's very dynamic, but those are some axes we look at. I guess some of them are specific to PE, some are quite common to what most investors would do.
You mentioned venture funds having to make like a lot of bets to get the returns that they need, just to spread the risk around. How do you think about that in private equity, right? So how do you trade off, for example, you typically take board seats, etc. So the amount of time that each partner is spending on the investments. So the number of individual bets that you're placing versus this payoff pattern, which, as you mentioned, is not so prominent in private equity, but I'm assuming that there is at least some element of that.
Yeah. So again, to be honest, I'm sure different funds are different, but I think for PE funds, you try to mitigate the risk, right? So you come in late, where even the tech business has proven economics, proven growth engine, very good team, and so on. And therefore, you get it a bit expensive, honestly, right? So you can't have it both ways. So I guess you end up compromising on absolute return because you come in late, but then it it can then fit in with the rest of your portfolio. Chances of such investment going bust and all it's a different risk profile, so to say, right? You solve for that through stage.
All right. So I think those big pieces you've got ideation, you've figured out how you do the analysis, and then you've talked about portfolio construction and etc. So I guess, and there is of course there's a lot more we could talk about, monitoring and controls, etc. But let's not sort of go there now. And just I'm going to completely change gears here again, and talk about a very different thing. So let's say there's a young person who's looking to sort of build a career in investing, and you've already talked about how private and public equity investing is different, and he's trying to figure out where he or she should go, and given the choice, what sort of skills this person should be acquiring. You did mention early on ability to communicate, people skills, etc. So how does this decision affect the kind of skills the person should be building? And to flip it around, what aptitude or pre-existing skills one should consider in trying to decide between going into public versus private equity investing? And this is obviously for a youngish recent graduate.
So I guess the answer does depend a bit on where the person is coming from. But I guess there are three dimensions. One dimension is just the analytical part, which is the investing principles and the microeconomic analysis. So you look at a business and it's a microeconomic question, right? Why does it exist? Why does it grow? And why does it create return? Can you sustain it? And you try to solve it. So there's an analytical piece. There is a people piece, which I was referring to earlier in the discussion, which is pretty substantial in private equity, because especially if you're a minority PE, then you're put in a position to influence, sometimes by saying no, and sometimes by trying to push the company in a certain direction. So that dimension becomes quite important. And even within investment practice, right? You have to convince other partners. You have to work with other investors. You have to convince other investors. It's not just interaction with founders. And it's I see it as a healthy thing, by the way, right? So generally, in most companies, this is a good type of tension, because you don't want to be also just over friendly. You want to have a successful business. So there's a healthy amount of tension is needed. But I don't believe that everybody enjoys this part or everybody is great at this part. It can easily be learned, but it's a whole kind of new dimension. And I guess the third dimension is deal making. And this is about a lot of things. One is just building trust instantly. How do you build trust very quickly? Both ways. So you want to be trusted, but you also want to be a good judge. And then there's negotiation. And then sometimes there's a lot of creativity in solving deep problems and getting it done. And there's a lot of process management to be able to do it on time and stuff. So I guess this deal-making, investment bankers or investment banking as a field kind of trains people quite a bit. People, I guess, consulting or just doing business in operational or some such capacity, I think teaches people a lot. And investing principles and analysis, I don't know where do people learn that? Maybe they learn by themselves, and with so much resources out there, right? So I guess you try to judge yourself on those three dimensions. If you're way more into analysis and way less in other two, then you may enjoy public more than private. If you are quite excited about people and deal making, then you might enjoy and be good at PE. There are also people, by the way, I have met and come across who are very, very good deal maker, but they actually do not enjoy or have not necessarily done a lot of work on the first two, right? Even analysis. I mean, investment bankers are trying to get a deal done. They're not trying to, they don't take the risk themselves. right? They don't stay with the decision for years and years. Therefore, they're not incentivized to necessarily look under the carpet for every little thing and so on and so forth. So for those people, and deal making is also a hard job and very well remunerated. So there are a lot of people who are well suited for IB. I don't know if that answers the question, but broadly across those three dimensions, I thought is what young person could think about to make their choice.
No, of course, I think it does. It's great, right? So you say analysis, you say people, and you say deal making, and that actually is a good segue into my closing questions. And the first one would be, just knowing what you know about the world today, what advice would you give to your younger self? You're just starting out in college or just starting out in your career. What is it that you would want a younger Pranav to know?
It's a difficult question. I guess I would tell my younger self, maybe even my current self, to seek mentors because I think that short circuits learning. So it's probably worth it. Now, some of these podcasts are also good, right? You're basically getting mentorship at a level that was unimaginable before from people who are doing something, practicing something for years. They're thoughtful. Learning from them, I think, is an excellent way to short circuit, maybe save years of your journey.
Okay, that leads very nicely into my second question. What content, do you consume on a regular basis? Podcasts, magazines, blogs? What are some of your favorites within these that you just can't do without?
So, I mean, I do read The Economist and FT, but my big hack is that I follow a lot of people in Twitter in areas of my interest. And then I use an app called Nuzzle, Nuzzel. What it does is that basically anything on my Twitter, which my Twitter network is retweeting, right? So it's a bit of a curation by my own network. Then that gets surfaced up. So I try to make time to read that. So basically, I follow relevant people, and then I have a system to study or read up on what my network thinks is very valuable. So that works out quite well. If I recommend this to whoever is listening.
Yeah, that's a fantastic idea. So you get your own personalized recommendation system.
Exactly. So for example, I told you, I like development economics, right? So I'll follow some of these guys. And then I usually would have the best content in the subject in the last month or whatever on my radar because I follow the main guys, right? And they would likely be talking about it. So that's the benefit of it.
Okay. And so within this, maybe articles, maybe books, over time, what are some of the most important books? And important, I mean, in terms of, how they've impacted the way you look at the world or, the way you look at life. What are some of the best books that you would recommend or articles you would recommend to our listeners?
So I must mention, this is a broad question, but I must mention one book that you, Parajat, gifted to me maybe a decade ago. It's called Rational Optimist by Matt Ridley. And to complement it, maybe Sapiens. I think why it made a huge impact on me was just to appreciate how far we have come as a human society, and to just better appreciate that even a middle class person today has access to things and stuff that even the kings and queens of the past, even 300 years ago, didn't have. From electricity to medicine to entertainment to whatever have you. So I have a deep appreciation of this reality that in the history of our species, right, we are just so tremendously fortunate to be living in 2020 versus any other time. Of course, there's a lot of suffering in our world, but this appreciation, for example, I mean, a queen as reading in Sapiens, I think. The queen in Spain had 20 childbirths, out of which many didn't survive. I mean, no modern woman has to go through that, right? So that is the one I'll mention. Those two, actually, I'll mention. Yeah.
And finally, and I think this is very relevant to people in finance, I guess. When we talk a lot about luck versus skill, right? But in life, as well, there's so much that is just dumb luck, right? You could plan and then things happen that are just luck. So, what would you say has been the luckiest break for you? Without, if that hadn't happened, you would be in a very different place. Something that you believe was like a very, very lucky break for you.
For me, actually, yeah, a lot. I've been fortunate in a number of things. It's also a difficult question, but I guess I went to a boarding school when I was quite young. I think grade 5 onward. It's called Ramakrishna Mission in Devghar. I think that was a very lucky break because my native place is in Bihar. I don't think it would have been possible to, in that environment, to get some of the success that I got unless I had gone to my boarding school. And my boarding school, it's so interesting, right? I think all of us benefit from what our predecessors, I'm not saying ancestors, but what our predecessors have done for us, right? And therefore, we all have a responsibility to leave the world a better place. So in that case, I think that school and that institution was founded by Swami Vivekanand, and of course, all his followers who have toiled hard to make it happen. So that school was very good for me. A lot of structure, education combined with a lot of ancient Hindu wisdom, meditation, and sports and extracurriculars. So you just get a quality education as a child born in Bihar. When I was born, GDP per capita of Bihar would be very low, like really low. So maybe less than $500. So to be born in such a place, although my parents are not poor, I mean, but also not very rich, where I guess middle class. My father was a professor in a college, government college. But to be born in such a place and still to make it where I am, at least, I think you do need some luck. Of course, I went to IIT, and that was a great, I guess, that helped a lot in everything that happened later. But if I think about different events and people, institution, I'm most grateful to, I guess that would be my boarding school.
That's a great answer. Thanks, Pranav. It's been great having you on the show.
Thanks for having me, Parijat.